Hello everyone, Theunis here. Today we're going to talk about Japanese candlesticks in practice. But before we start, as always, I just want to check if you guys can hear me, if you can see me. I see we've got a couple of guys, Sophie, Tasma, Tina, Liana, Karobo, Helen. We've got some ladies here today. Welcome. Can you guys hear me? Can you see me? Sophie, yes. Barry, Barry, recognize you from previous webinars. Yes, it seems like everybody can see me and hear me. Right, guys, Japanese candlesticks. Very, very interesting topic to speak about. Let me just put it very straight to you. Japanese candlesticks, yes, we need them. They're beautiful things, gives us a lot of information. I talk about them as the footprints in the sand. So you can deduct a lot from a candlestick, but they are very, very dangerous as well. I regularly get traders that come to me and they say, yeah, they've studied candlestick formations and they know it's very important, the price, but they don't seem to be able to make a net profit over a series of trades. They win some, they lose some, and that they stay in a break-even situation. And that's part of the problem with Japanese candlesticks. They are nice, they are useful, but if you don't apply them at the correct places, they can be very dangerous, right? Again, back to that entertainment trap. Anything that keeps your eye off what I call the structure of the market, the language of the market, makes it very difficult to make a net profit over a series of trades. So today we're going to look at a few candlestick formations and we're going to search for them on the live charts and see where they are meaningful, where they are not. Right, so before we start, I'm just going to I'm going to show you quickly what I do. It's going to give you some perspective. When I get traders that are new, that want to learn to trade, but they're serious, they don't want to get into that entertainment trap, they don't want to, they realize perhaps, or they read somewhere that this holy grail thing is not a method, it's actually a whole, what I call a foundation, right? It's getting a few things in place, not just a couple of candlesticks or an indicator or whatever, right? The process I follow with them is the following. I detox them, right? So I declutter them. The language of the market is actually very interesting or very simple, but it's not easy because we tend to clutter it so much, right? So what you're looking at in front of you now is a chart, the Euro USD 4-hour chart. So how we start, new guys, but especially guys that have been stuck, that have been trading for a while, and they don't seem to be able to make a net profit over a series of trades. Normally they've got a couple of indicators, they're looking at chart, candlestick, formations, patterns, whatever, but they don't seem to be able to make a net profit over a series of trades. So what is the problem? So let's put it into context. What you see here is the structure of the market. This is the market's perspective. There's only 3 dimensions. It's a very simple language, only 3 letters in this language, right? And this is very, very simply uptrends, downtrends, and ranging market. There's an uptrend that is higher tops, higher bottoms. There is lower tops, lower bottoms. That's a downtrend. And then there's a good example of a ranging market. All right, let me just continue here. Uptrend, downtrend, uptrend, downtrend, lower tops and bottoms, and then there's a very, very good example of a ranging market. Market not making consecutively higher tops or bottoms or lower tops and bottoms, right? So what we're looking at here is I've given the language of the market structure. This is the language. This is a perspective of the market. Anything else, anything you add to this without this being the most important part is going to cause you issues. It's going to cause problems, and it's going to make it very, very difficult to make that net profit over a series of trades. We all know that technical analysis, proper definition is we look for, we study price, we look at the charts, yes, but why? We're looking for to identify early stages of the next trend, right? And that is what successful traders simply do. They see the structure, they wait for early stages of the next trend, and then they take a calculated risk there and they manage that risk. That's not what we're going to talk about. we're going to talk about early stages of the next trend, right? I immediately can see where I'm going at. From a business point of view, if you take a calculated risk at the early stage of a next trend, then it means, very simply put, the risk you're taking there is small compared to the potential profit you can make over a series of trades. Never 1 or 2 or 3 trades, over a series of trades, right? So here you can see I've added the candlesticks, and unfortunately, because guys study it so much and they think, a couple of candles and they want to trade. All right, very, very disrespectful to the market. You're making it difficult for yourself to make a net profit over a series of trades, right? It's only in those areas that the candlestick, and not even the pattern so much, the flow, the structure of the market first and foremost. That's why I have to, sometimes it takes time, like it did for me, to detox, to declutter, to realize what this means. What is the structure of the market? Higher tops, higher bottoms. To see the structure on the line chart is very easy, but we cannot only use that. This is just to see the structure, to practice the structure. I call this exercise sitting on the beach and watching the waves, watching the ebb and flow of the market. And let the guys draw this going back into especially the 4 hours, because it's such a nice nice structure there. So seeing, going back, drawing in that structure, defining, getting a respect, a healthy respect for the structure of the market and from its perspective, right? We're looking for that structural change there, higher tops, higher bottoms, and there it changes. We don't know why, we don't care why. We can see the change, right? So the first step is the line chart to see the structure, declutter, and then the second step is we add the emotions. That's what the candles is for me. It's the emotions. It shows you the emotions, why the ranges there. It gives you a lot of information, right? But before we go to the candles, I still have the guys practice to see the structure. There you can see there was a higher top. There was a higher bottom. There was a, let's discontinue that one, a higher top, a higher bottom, a higher top, even then a higher bottom, and then something changes, guys. Something changes. Not looking at the candles at the moment, looking at the flow. That was not a good pullback for me. That's why it takes practice, these seeing the structure of the market. Some guys would see that as a pullback, some not. It's not right or wrong, but look at the structure of the market. Look at the change of the structure of the market. There it makes a lower top, and then when it goes past that previous bottom there, it makes a lower bottom. Higher tops, higher bottom, uptrend, lower top, tops and bottoms, and it's a downtrend. There was an early stage of the next trend. We could have taken a calculated risk. Right, so let's get rid of these, the last few trend lines here. Let's start looking at the candles. What I'm going to do is I'm going to alternate between my presentation. Let's get them rid of them. Yeah, right. And then we're going to use this as a sample size, or as a study, or what do you call it, example. Right, so let's go back here. Okay, like I said, the foundation, you need the structure of the language. It's the first time, early stages of the next trend. Actually, your mind is the most important part. You've got to practice this. So just like going to a gym, practice, make your muscles strong. Then the structure of the market, early stage of the next trend, that's the method. Can add a few indicators later, but just for visual effect. We focus on the structure, and then that risk, money management, all important part of that foundation, right? So let's look at a couple of them. Right, now this is what you see in the textbooks and the stuff. Very, very clean, nice and clean examples. This is an example of a long white body, and it means the market was going down, and all of a sudden you've got a single very prominent bullish candle there at the end. So let's go and look for these ones. Right, so you've got down movement, and you've got a very good, all of a sudden, a bullish there. But can you see where it is in the structure of the market? Let's zoom in a little bit. Let's stay there. There's so many of them. Market is going down. You've got this huge bullish candle here, and immediately the guys start buying. Right. According to me, it's very disrespectful to buy here. Why? Yes, there's a downtrend, but that single bar is still within the flow, the ebb and the flow of a downtrend. Higher tops, higher bottoms. It takes some skill. That's why I tell the guys to alternate between the line chart. It makes it easier to see the structure of the market, and the candles where you add the emotions. But we do need the candles because the candles is going to show us the points where we enter, show us that extreme points where the emotion was added to the structure, so that we can put our guidelines, and we like using the Fibonacci guidelines, very well researched. The 161 is always a very good. We don't use it to trade, we just use it as guidelines to put our stop loss, our entry. Is nice because you can customize it. Our first take profit, when we train, we take 50% profit there, 25 there, and 25 there, just not too complicated. Later we optimize that to get the better risk reward ratio. But in the beginning, you've got to realize, just when you go to the gym, you cannot go to the gym and start bench pressing 300 kilograms. You're gonna rip your muscles apart, a lot of pain, right? So does it mean you can never gym in your life again? No, it just simply means you didn't understand the process. You had to start with small weights. You had to get the basics right first. The basics of gym: you have to eat right, you have to rest, and then you have to exercise. That's what we're doing here, the basics, the structure of the market, taking calculated risks and managing that risk. You got to get that things in place. Then candles become valuable. Right, before that, candles can be very dangerous because guys tend to see a couple of candles, they jump in, and then they don't understand the ebb and the flow of the market, right? And the problem is, like for instance here, like let's say a guy decided, no, there's 3 candles, he's going to jump in. Sometimes it's going to work out like this, and it's just because he's lucky, right? But to make a net profit over a series of trades consistently, you can't just depend on luck. You've got to respect the structure, master the structure, seeing it, and then taking your calculated risks in the early stages of your next trend, right? So what do we see here? We see, for instance, there was a bullish candle and the market flow was not changed, market structure hasn't changed, and then the downtrend continues. So that is not, that is, like it says here, it's part of a potential bullish reversal, but you have to be very careful, guys. In that candle specifically, yes, demand was greater with supply. It's a bullish candle, and yes, it's a possible end of a downtrend, but not necessarily. So this is why my opinion is the guys that read books about candlesticks and stuff are just making a lot of potential problems for themselves. The only books that I really especially in the beginning, when you do not have the skill yet to make a net profit over a series of trades, the only books that I suggest is books about the psychology of trading. How does traders think? That mental process, that mental training process that you're going to go through, right? So the basics is very easy, like I've shown you. And I've got there's numerous recorded webinars that you can watch in your own time. Foundation of Online Trading, where I explain this. In fact, I explain it every time when I talk because I know guys fall in that trap so much. Right, so let's look at another one. Another couple of down candles, and then you get a this one is called a hammer, and obviously we can see supply is greater than demand. It is definitely a bullish candle, but let's go and see what happens. Right, so there you see a bullish candle, part of the flow there. It still made a lower bottom there. So is that candle enough to jump into the market or not? Entertainment, yes, but from a structural point of view, if you want consistency, if you want long-term net profits over a series of trades, then no, not. It's still part of a downtrend there. We wait for the structure. There it makes a lower bottom, or sorry, a higher bottom. That was a lower bottom, that's a higher bottom, and then it starts making higher tops and bottoms. And what you see, which is interesting, is those type of candles, hammer, and it's complement the shooting star. There's the hammer, so it's pointing up. The shooting star, we'll get to it a little bit later, is pointing down. They very often happen at these turning points, and it is part of, if it's part of the flow, It's very nice, but again, very, very dangerous if you try to enter in a later stage of the downtrend. For instance, here you can see it's definitely not the early stage. Let's see what happened here. The most lower tops, lower bottoms, lower tops, lower bottoms, continuing lower tops. So it's in a late stage of the trend. So if you enter there, your chance of making the risk you're taking compared to the potential profit you make over a series of trades is going to make it difficult for you to make that net profit over a series of trades, because it's not the early stage of that trend. We want as much profit. Sometimes the market is generous, sometimes not. If the market is generous, we need to take full advantage of that profit. We cannot afford not to take it. So if you enter late, then you're at a disadvantage already. And you'll see that I'm talking continuously about a series of trades, right? A sample size or a series of trades. Beginning guys tend to take 1 or 2 trades. They're lucky. It's a winning trade, and they think that's a good trade. Profit is a winning trade, and a losing trade is a bad. Totally wrong. It's not got nothing to do with that. A good trade and a bad trade has got nothing to do with a profit or a loss. Right. Get back to that later. I think you should be able to deduct what I mean with a good trade. Right. Right. So let's see. Here we've got another hammer. Was it the end? Was it a good point to enter here? It's a very, very clear hammer here, pointing down, going up. Didn't really close much above it, but it's very close. The structure. So it's down. It's part of a downtrend. So if you take these kinds of candles in the opposite of the structure, then you're just looking for trouble. Or that's not looking for trouble. You're making it very difficult for yourself to make that net profit over a series of trades. Right. So there's a downflow, and you see lots of times you get hammers in those swing movements. Right. There was a higher top, and there it goes down. Part of that movement there. All right, a lot of guys I know love these type of things, but again, they're useful, but just use them in proper context. Allow yourself to flow with that ebb and flow of the market, right? Respect the market structure. All right, let's jump back. The reason why I'm doing this is I want you to see how it looks in the books. It looks so easy, and then the guys start trading these candlesticks patterns, and I don't know why it's so difficult to make that net profit over a series of trades, right? What we've got here is a piercing line setup. Demand is greater than supply. We had that still a bearish candle, and the bullish candle closed more than halfway. That is one of the problems with the candlestick formations as well. I mean, to me, it looks very much like that long white one. So the guys get confused. They've got different names. You've got the traditional names. You've got the modern names. Some guys take those like the previous hammer and the Morningstar. They call it a pin bar, and in the end, it confuses a lot of guys, especially in the beginning. The thing is, if you've got the structure figured out, if you take that early stage, you take your calculated risk, you manage your risk, yes, then things like candlesticks patterns will enhance your trading. Same goes for indicators, same goes for support and resistance lines, 8 waves, all those things. The moment you take the weight off that structure, then the accuracy of your trading just go way down. We've got very, very good strategy managers on our FXTM Invest, and when I help people that are starting to build a portfolio of strategy managers to follow, starting very small, then we look at the different ones, and now time and again I see a very good one. He or she can make a net profit over a series of trades. You've got that. Let me just show you here. You've got that beautiful equity curve that's going, and then whop, they've got this big drawdowns. And when we go and look what happened there, then you get you can clearly see at those times guys looked at different things, like perhaps a formation, a candlestick formation, or a level, support and resistance level, and they didn't respect the structure, and this is what causes these huge drawdowns in their account. Not necessary. That is it's really a privilege for me to help guys like that, and then the accuracy, that drawdowns don't happen anymore. So That is what we want. We want our clients to be successful. We want guys that have a passion for this to become, to become better and better, and then also become strategy managers, because then you're blessing other people. They can build a portfolio with you as one of the strategy managers, and that you get the profit share. So it's always good business, is always a win-win situation, guys. Right. So let's go look for. I think I'm going to skip this one because it's so similar to the other one. Let's go and look for some other ones. Right. This is a RAMI, equilibrium, indecision, a neutral type of a bar, a warning of a possible reversal. Right. Now you'll notice that you'll see them everywhere in the sense of indecision bars. Right. So let's look for a couple of them. So we've got market going up, flowing down. There's not a good RAMI, but there's an inside bar there. Tries to go up there, tries to go down, inside bar, then it flows. I don't know, guys. For me, once you start seeing the structure of the market, then the candles, except from the fact that they show you the emotions of the market, doesn't really mean so much to me, even if I see these beautiful candles. So you see the structure, you take the early stage of the next trend, and you don't have to remember all those lots and lots and lots of different names and stuff. Right, let's see. But you have to go through this. Rami, did we see a good one? No, I don't think so. Let's look a little bit further. Let's get rid of that thing. All right. We see a flow, not a good Rami there. A flow. Looks like we're having difficulty seeing a very good one. I think I'm so used to just looking at the structure, seeing it inside the candles now, that I don't even see the pattern so much anymore. I used to be a buffon, but it didn't help my trading ability or my ability to make profits a lot. So right. Okay, this is a engulfing pattern. As you will all see, also see demand is greater than supply. It's bullish, and there you see a possible one. It went down. It totally engulfs it, but it's still part of a downtrend. So is it now a good entry there? I suppose if your risk management is very tight, you can take it, but dangerous. We want to stay in the ebb and flow of the market, right? So there we can see a down move. There's a structural change, down move. It goes up, it goes down, and there it goes up. If it's in the direction of the trend, then it makes much more sense. Right. We don't see a very clear one. There is also sort of like engulf. No, that's not engulfing, sorry. There's more. Looking for a nice one to show you here. Right. The reason why I don't talk a lot about Japanese candlesticks, and why I actually do these seminars and I give it a title, is so that guys that do think it's important can I almost want to say learn the truth, but hear my opinion anyway. So so the candlesticks and formations makes sense, but it can very easily bring a lot of clutter, because now you're trying to see, okay, what is this? Is this now a Rami? Is this a spinner? Does it mean anything on its own? Am I going to take this trade or not? Within the context of the ebb and flow of the market, the structure, that all disappears, guys, right? So we're talking about candlesticks, but I'm actually telling you that they're not so important. Okay, another one. Right, now here is a different thing, a morning star and an evening star. It's the counterpart. This is a three candle formation. Right, so now we are getting a little bit better with the flow of the market. Can you see the flow here? The market goes up, starts flowing in different directions. Still not part of the, still not a structural change yet. I like to see a flow back, and then making a higher, this is a lower bottom, making a higher bottom, and then going up, right? According to me, that's better. But anyway, you're starting to see with more candles, you start seeing, start seeing more of the flow of the structure of the market. Right, let's go look for a couple of them. So there you see the market goes up, turns around, and starts going down. Let's just see here. Now we want the opposite. Going down there, not a very good one there. Starts going down there. Not a very good there. But the point is, I want you to see, even if you get a perfect one, guys, if you get a perfect one there, if it's against the trend, if it's against the structure, you're looking for difficulty, you're looking for trouble. If it's with a trend, let's see if it's going up. Okay, that's a morning star, and then it goes, there it goes again. So sort of like one there, then it's more potential. But again, where is this? Is this at the early stage of a next trend or not? Do you want to make it easy for yourself to make a net profit over a series or not? Right, so I'm coming back to this again and again and again, and I know a lot of guys get frustrated with me, but the reason why I do it is because you have to hear it often. When you go to a gym, the most difficult time for you, if you want to really pick up weight and build your muscle density and so on, is after you figure out the basics. Okay, this is what I need to do. This is the exercise I'm going to do. I'm going to rest. I'm going to eat right and so on. Then you go to gym week by week by week. You mustn't mess with the basics. You just do it over and over and over again. Very entertaining to do other things in between, but if you have got a purpose, that is to pick up, weight, to look, you want your body to look good or whatever, then those, you know what to do, just doing it every single day. You're not going to notice a change immediately, but as you go on week by week by week, your muscles pick up tone, becomes more dense, and you see other people actually tell you, oh, you're looking good or whatever. It's the same process that we follow here, guys. You have to hear it, you have to see it, you have to practice it, the flow, and then as you practice, then it feels boring. Oh, where's the excitement now? That's a good sign. It means you're getting out of the entertainment trap and into the real business. Any real business that you do is when you figured everything out, you're doing it, it can become boring, right? If you enjoy the business, and obviously it will not be, but the mechanics all over and over and over, right? So now I'm not going deep into the structure or the patterns itself, but that's for a reason. So I trapped you guys. So some guys would think, he's going to show us the holy grail pattern or the pattern that works better than anything else. No, guys. I'm showing in the end, I want you to become a successful trader. I want you to become a trader that makes a net profit over a series of trades. And for that to happen, the structure must be in your mind. You must practice that. And then the candles, and then the early stage of a next trend. And then the last part is taking that trade with a calculated risk and then managing it. All right, we never know how far the trend is going to go. I don't care if you've got a doctor's degree in candlesticks or indicators, I don't care. So you are not going to know how far the trend is going to go. We don't predict the market. We see the structural change, we take the calculated risk, and we let the market flow, let the market speak. Sometimes it's generous, sometimes not. If it's not, if the structure changes, let me look for an opportunity there. So let's say you saw this is a higher top. There was it's a perfect example. There was definitely an uptrend. There the structure changed. There the structure changed. There was a higher top, a higher top, a higher top, a lower top, and there broke past that one, and you entered there, and the market engaged you and immediately turned around. A very, very good trade this. Why? Because we saw the early stage of an next trend, we took the calculated risk, and then we protected our account. All right. If you don't protect your account there, you would have had serious drawdowns there. We never know how far the market is going to go. We just respect it, listen to it, take our calculated risk, manage our risk. That's how we get the ability to make a net profit over a series of trades. No other way. No other way. There the market was not very generous, but we protected our account. And there was a structural change. You can see higher top, higher bottom, higher top, higher bottom. But if you're there, like that breakout, and then it makes a tries to go higher, cannot, and there was a very, very generous trade. The market was extremely generous to us there. Right, that's what I want you to click, because if you click that, then you have the potential to start building those muscles and to start to actually make that net profit over a series of trades that we all want. Right. So I hope you're getting the message. Right, now this is bearish reversal, so it's exactly the opposite. See a question here, guys. Anyway, anytime you want to ask a question, please do. I love questions for the simple reason that when you master anything, you have to try, you have to learn, and you have to grow. So learning process is you ask questions, you get answers, and you discuss them, and then in your mind, in your mental framework, your mind, neurologically, physical structures happen. Dendrites, neurons, and dendrites form, and that's how memories form. That's how you master anything, right? So Festus asks, where can I get this video? Festus, you can just email me. I'll put on my email a bit later, and then I'll send you the link. Unfortunately, not all the webinars are posted on the website, the FXTM website, but they are, for a couple of months at least, they are on the GoToWebinar, and I can give you that link, and then you can go and watch them. That's the purpose of these things. They're very useful. So you can actually learn a lot through these recorded webinars, because that's part of this the fourth industrial revolution, the whole training thing, that you have access, and you know, it just makes it easier. One-on-one talking to guys has limits, and at least with Skype and Zoom, it's better. You can talk anytime. You don't have to go physically to the person, but still that's got limits. So the recorded webinars takes away some of that limits. So if you log on to your my FXTM profile, and you go to the education part, bottom left, then let's go there, guys. Let's go there. I know there's a lot of beginners in all these sessions, and I don't like to skip. If you log onto your account, I think we've got still enough time. We can see if we can catch a few, perhaps catch a live one there, the 1 to the 5 minute. Right, so you log on to your FXTM profile, you go to education, you go to webinars, upcoming webinars. If you scroll down, you get past webinars. There's a whole treasure trove of webinars you can watch. Don't get caught up in just watching webinars. You can't learn a language by listening to other people as well, or just listening to other people. You have to practice. So there's a couple of them here. I know there is one about, let's just search Japanese. There is introduction to Japanese candlesticks, another perspective. Okay, it's myself, but I think there's a couple of other guys as well. A very important one for beginners, a foundation of online trading. What do I mean with this? If what I'm talking today is a lot of blah 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 for you, strange words, then this is the second part. The first part is a little bit lower. There's the first part. Right, then you have to go and watch this. Get to know what I mean with the foundation of online trading. This is what I talk about, this language. Right. Okay, let's go back. Let's see. Okay, now this is exactly the opposite. So I don't want to really waste too much time here. I hope you guys understand. Let's see, there's some questions here, and then we go and look at a couple of live ones and see if we can. When they say hunting lions catch prey, so let's go and hunt. First, a couple of questions. Right, Bezad asks, how about using zigzag to understand structure of the market? Is it easier than lines? Bezad, that is exactly what I mean with the structure of the market. There's just a problem with the zigzag lines. Right, the zigzag lines is an indicator, and somebody programmed that indicator, and their interpretation of it is what you're going to see. Right, so if I look at this structure here, then what I might see is a higher top, a higher bottom, a higher top, higher top there. There was not a nice pullback there, and then a higher bottom as well. Another guy would say, no, he doesn't like that. So he says that wasn't a good pullback. He'll directly go to that. And if the problem is, it's not right or wrong. The problem is how do you see the structure? You listen to other people, or can you see the structure? If you practice this ebb and flow of the market, the zigzag does not supplant or it's not better for me than the seeing it on the line chart first, because I want you to get to know it firsthand. If you put on the zigzag, then you are trusting another guy's interpretation of this wavy structure here, and it's not going to be right. It's an indicator. When you practice it yourself, if you do like the zigzag, yes, use it, but just test it extensively on old charts before so that you can get used to it. Because if you do like that ebb and flow, and remember, you can set it. It's got different settings. There's a default setting. You can set it more, bigger or smaller. It all influences that. So yes or no to that answer depends on you. Right. Okay, let's see if there's another one. That's a good one. Karabu, how long did it take you to make a profit in Forex? Guys, like I said, I blew my first account very, very quickly, and it's a good thing, because then I realized this is not as easy. It's simple, but it's not as easy as it looks. And then it took me, I thought, still those times, I'm looking for the perfect method. I thought the method itself was, the holy grail. And for many, many, many years, I was stuck in that. I was working full time, and I thought if I just find the right method. So I bought books, and I also studied the patterns, and then tested them, and then traded them. But I couldn't, I made profit, and I lost it again, made it and lost it again. Right, and then it wasn't until I met this old gentleman that told me about the structure of the language. And I must honestly say, even after that, um, there were still some issues. The whole how you manage your risk, your money management. I was trying to make a lot of profit with every single trade, and that also makes it very difficult. We have to get like with this high probability, we have to manage our risk. For me anyway, it made a big difference to use a high probability risk management system where you take some profit, not everything, some profit, to manage that mental pressure. The mental pressure, when you don't take partial profit, means that the more in profit you get, then the more the pressure gets, and at some stage something snaps, and there's a big movement, and you get out, and the market didn't tell you to get out, and then you miss out on a lot of profit. Or you just you panic, you don't get out, and you lose a lot of your profit. So that is just, so it took me a number of years. That's why I love training as well, because I can help guys not fall into those traps. So for me, it took me, the holy grail phase was a lot of years. And then when I finally realized this, I started practicing to see the structure. The old gentleman warned me. He said, Theunis, you in your brain, you've now got a lot of bad habits. It's going to take a while to practicing out of your system. And it took me a while. It took me about 2-3 years. So I would in all honesty say it was only the last 2-3 years that I started making, at least a net profit. And then the head of our education professor, and a professor, is Mr. We just call him Prof. Andreas Delasinos. He also just hammered on the basic structure, and especially this guidelines. So the Fibonacci guidelines, the high probability money management, and then everything just clicked. And then it became easy to stay in that ebb and flow, a lot of less pressure, and it just became easy to make that net profit over a series of trades. So that's why when I train with guys, I just want to get them to get out of the entertainment trap, and as soon as possible to get into that ebb and flow of the market, strengthen their mind, their mental framework, and then, because I know it works. I sometimes tell the guys, I don't know if I said it now, but I've got a doctor's degree. I've got a doctor's degree in making mistakes. I made all the mistakes in the book 20,000 times over. So, right. Hope that answers your question, Karaba. Right. So Hael asks, I want to add from my experience, understanding that if the reversal candles are disappeared near the resistance line, then these should be taken more seriously. Please confirm if this is a correct observation. Very good observation, but also very tricky. Support and resistance lines is also secondary to the structure. I all too soon get guys that they see a support and resistance line come up and they start taking their profits, start reversing their positions, and the market structure haven't changed, and they just have to cover, and they get big drawdowns on their accounts. So support and resistance, it can fine-tune you, your trading, just like candlesticks formations can, just like a lot of other candles or indicators can. But if you rely on them, if you respect them more than the structure of the market, they're going to bite you, right? We have an excellent strategy manager, but now and then she has these big drawdowns, and we couldn't understand why. And a guy that was interested in investing with her asked me to check with him, and we checked. We know what currency pair she trades, so we checked in those times, what happened there, and we could clearly see there was a daily support level. Let me show you quickly what happened to that lady, just so it makes sense to you. All right, there was a downtrend going, and there was a daily support, resistance, or support line there. And what happened is that the market went up and started changing the structure there. That's fine. The structure changed and she took some long positions, or we deducted she took some long positions there, which is fine. But then the structure changed again. It started making lower tops and bottoms, and we assume she started adding positions there, and then the structure just never changed again. It sliced through that support level like hot butter, like a hot knife through butter. And there was a massive drawdown on her account. Luckily for her, the thing didn't go too long. She obviously didn't wipe her account. She's a good strategy manager. There was just a crack in her foundation, and then she started recovering here, and I think she hedged her positions there. But so unnecessary, guys. Your accuracy, if you respect the structure, just gets so much better, right? All right, let's get off here. Getting sidetracked here. All right, another question. Right, there's some questions about how to set up a stop loss. That's what we're going to discuss today. There's some webinars about that. Please email me. I'll put it up later. Perhaps I should put it up now. Yeah, I think I'll do while we talk on about a few of the questions. Right, there's my email. Just email me. There's a couple of webinars that I can just send the link to you about how to enter, how to put your stop loss, how do we manage it. Do we use trading stops? No, never, for a very, very good reason. So there's a lot of points there that I can give you. Right, next question. How many strategies do we need to be profitable? How many strategies do we need to be profitable consistently? Right. Konofelo. Right, Konofelo. If you understand the structure of the market and you look for that early stages like I showed you, then and you take a calculated risk using the guidelines and you manage that risk, that's all you need. Right. So in terms of a strategy, a couple of years ago, I had a real deep epiphany. Part of the books I bought, people I talked to, everything, and I met some really seriously successful traders, but for some reason I just didn't click what they were saying. And you're looking at the method they're using, you're thinking that is the secret. And what happened to me is I was thinking, and I heard this structural thing, and I was wondering, why, what am I missing? And I decided to take all the few, there was about 3 or 4, 5 very good strategy managers or very good traders that I've met. I took their strategies because they always seem to share it. you know, so especially the ones with very simple ones. And I took away all the indicators and I put them, you know, beside each other, and I saw, like, so obvious, that's all they do. They wait for an early stage of an X trend and they take it. They just have different indicators on, because they use the indicators like for a visual confirmation or something, for a visual enhancement, to make it easy to see that early stage of an X trend at a glance. And I think that's when it really turned for me. So I decided to focus on that, and then, you know, it turned. Right. So you don't need many strategies. Actually, one main one, that's the flow. But what tends to happen out of that is you get like a few niche ones. One especially that a lot of guys use is the London breakout. The market is with the Asian session sometimes in a tight range, and then when big volumes come in with the London market that opens, then there's a breakout out of that range. And some guys trade that. You just have to be very careful. You have to manage your risk very well there. Some guys wait for the breakout and then wait for early stage of an next trend on the, you know, the lower time frames, and then they take that the early stage of an next trend and manage it from there. Right. Before I see there's a couple of questions still, but let's look at the real charts. Okay. So let's go and do what I call a 1 minute exercise. Right, we go to the edge of the chart. This is a demo account. Please always do it on a demo. You don't want to do this exercise on live account. You're gonna wipe it. I'm just gonna do one more thing. You'll see, very interesting here. When you put in the beginning, when you open your chart, you'll see it's only one gray line there. What I want you to do is to go to, let's do it like this. This is how it's going to look, right? But this is not the complete picture. You want to see the spread. You want to see what's the difference between the ask and the bid line. So what you do is you left click on your properties, go to colors, common there, and show ask line, right? And then it shows you the spread there. Spread is too weak here for the 1 minute, or too big for the 1 minute. So I'm just quickly going to go to my ECN account. You see the difference. ECN account is more for lower time frames. Can you see? Huge difference, guys. Here you can trade. Spread is not interfering with the structure of the market. Right, let's see. We have higher tops, higher bottoms. The guys, if you've spent a lot of time looking at the candles, you'll see a lot of candlesticks formation here, perhaps, but beware. Right, I see higher tops, higher bottoms. This was an extended correction wave, not enough information, not enough structural change to be the early stage of an X trend. Just one lower bottom, and then it's made a higher top. So it continued. There's that one. It's also higher. So there we've got our first, still a higher top there. It goes down, and then it makes a lower top there. And if it went past there, my entry would be there and my stop loss would be there. But as you can see, it didn't go. So, and now the market has started buffling here. This is a ranging market. A lower top, didn't make a lower bottom. That's a higher top. Now it looks like it's going to make a higher top again. So ranging market, nothing for us to do here. Let's go and see if we can find the early stage of our next trend somewhere else. Right. Remember, please, guys, this is a exercise. 1 minute is very, very fast. So as we practice, I teach the guys the structure of the market. We go to the emotions, then the calculated risks, putting in the guideline on old charts first to prepare your mind to strengthen that muscles. And then when the guys are ready, then we do all sorts of exercises on a demo to help the execution. Right, this is one of those exercises. So we've got here is ranging market, random tops and bottoms, nothing for us here. Let's go and look for another place. Nope, random tops and bottoms, nothing here. Just make a point. I don't care what candlestick formation, guys, you see here. Very, very dangerous to trade, especially from the viewpoint of consistently making that net profit over a series of trades. Right, I don't care if you see the perfect, according to you, the perfect candlestick formation here inside a ranging market. We call that the killing fields. Right, that's where people blow their accounts. There's a balance from the market point of view. When there's an uptrend, there's more buyers than sellers. There's structure, there's momentum. When there's a downtrend, there's more sellers than buyers. Common sense. There's structure. When there's a ranging market, there's a balance between buyers and sellers. There's no direction, no momentum. Very, very dangerous. So, and I'm of course talking on a time frame. You can go to another time frame and there will be structure perhaps there, but not when there's a ranging market in front of you. What we've got here, I'm seeing a top, bottom, makes a lower top, a lower bottom, a lower top. It's made a lower bottom again. Right, let's see if this one turns around. Another good question, the guy said, but what about all these levels? For this exercise, especially when we're training to get our eyes in to solidify this structure, this language, this taking the early stage, you don't worry about resistance support levels. It's going to be a challenge for you to break even anyway. We just want to practice that, that muscle memory. When you've done that, when it gets easy to stay in the ebb and flow of the market, then we enhance our trading by, if it comes to if it's an uptrend and it comes to a support and resistance level, when it's just a warning that the structure might change. If it doesn't change, we stay in. If it does change, we need to protect our account, and if the structure changes, then obviously it might be a next trade, early stage of a next trend where we trade. What's happening here is, and I'm going to draw it in, there's my first, which I see made a bottom there, a lower top there, not necessarily a lower bottom for that side. Then it made another lower top there. There's my lower bottom, another lower top, and then lower bottom. So the definition we use for a proper down or uptrend is the Charles Dow one. He says if you've got two consecutively lower tops and bottoms and it breaks the lowest one, the second one, then it's a downtrend. Why? We want compression, guys. We want enough committed sellers to at some stage to cause like what we call a supply compression, and then at some stage the price cannot go lower forever. Some stage those sellers want to take profit, other buyers come in because the price is low, and then we get that beautiful early stages of a next trend. So we have to wait, we have to be patient while we wait. I don't care what candlestick formation happens here. Right, this is structurally wise, and I hope you can see this is a downtrend. It has to break through, or it has to, let's say it goes up to there, and it cannot make a lower bottom, it makes a higher bottom. The moment it turns around, guys, then I will put my guidelines there. That is where I will use a pending order, a buy stop to enter, and that's where I'll protect my account. Right, at this stage it's still in a downtrend, and this is a corrective wave. Okay, let's take that away. Right, while we're waiting for the market, just another word of warning, 95% of the time, guys, in trading, you wait. You wait for a nice trend. You wait for that early stage of the next trend. Then you put in your orders and stuff, and then you wait for the market to take it or not. And then if the market takes it, you wait for the market to go to your either your stop loss, protect your account. It's good if the structure changes, or your partial take profit, and you wait. So be prepared. It's not as exciting when you do it right as a lot of guys think. You wait a lot. Right, let's see while we're waiting for this market. Definitely made it looks like a turnaround there. Now the question is that a nice enough pullback? Was it still part of that's just a corrective wave, just the inside candle there? I like to normally see a nice definite, like there, a nice pullback formation, at least another candle going there. Sometimes if there's a a shooting star or a hammer there, then it's enough, and I take my calculated risks. That's why I say you have to practice. There's no right and wrong. It's how you see the market. It's how you speak it. It's how you pronounce it. Definitely a extended correction wave there, but what now? It's just going to continue down. Sometimes the market just goes up hugely, and it does give us a good structural entry point. That structural entry point, guys, is part of our risk management. Very, very, very important. So if the market just zooms out, you think, oh no, it's definitely going to continue, you already got trouble. You enter there, the market just turns around and stops you out. That structural wave makes it definitely now, guys. It's definitely busy with another potential impulse wave here. If it cannot go lower now, then if it goes lower, then it's just a continuation of the downtrend. If it does not go lower and it turns around, then I would put wherever it turns here, I put my stop loss there, and I would put my pending orders there. Let's see if we can get this one. When we practice the 1 minute thing, the 1 minute exercise, we use minimum lots. I use 0.04 because I'm going to take half my profit there, and then a quarter, and then a quarter. Right. Let's see. It's got a couple of minutes left. Let's see what the market does. Spread is a little bit bigger, so I'm moving it up to compensate a little bit there. Right. I think I'm going to put my order so long. I use a shortcut. In the 1 minute, you have to be fast. So I'm using that. Let's see. Some more. Please, guys, don't send me your email. Just send, no, don't ask me to email you from out of the chat. So when I finish there, see, we are inside the candle. But when I finish here, I immediately have other things to do, so I don't go back in and so on. So send me your email, and then I'll reply. Okay, as you can see, we had a structural higher bottom here. Didn't go very far, but the fact that it went past there tells me that, or says, the market says, Theunis, you're allowed to take a calculated risk, and then I do it. I'm not trying to predict. There's no emotions now. If the market takes me out now and turns around and takes me out, it's still a good trade. This definition of a good trade is what enables you to make a net profit over a series of trades. What I'm going to do now, if the market touches there, I will take partial profit. And the 1 minute, so it should happen. It's either going to take me out there, or I'm going to take my first take profit there. There is an in-between scenario, and that is, let's say the market it goes up, it doesn't reach my take profit, it goes down again, and then fails to go higher. Then that is not a very good trend, but it's definitely structurally wise a change. So I won't take another trade there, but I'll definitely move my stop loss then up from there to there. Right. So because the market is speaking, I just listen. What I'm going to do quick is I'm going to put my stop loss in there and my final take profit in there, and then it's partial profit there, partial profit there. Now we wait. Let's look at a couple of questions. Jabu asks, I want to know if I happen to know the following chat, technical analysis. Do I also need the following fundamental analysis? Right. Jabu, the difference between fundamental and technical analysis is big. Right. In the first place, with fundamental analysis, you need to have some economic background. But my problem with that is, even if you're the best economist in the world, it doesn't really enable you much to predict the market. You also, you see what might happen based on some reports and stuff like that. But do you really know what's going to happen? Fundamental analysis is about what causes the price to move. Technical analysis, on the other hand, is what the effects of what that, other people react to that causes, the effects of those things. And there you don't need to guess. You can see. You can see the structure. You can see the structural change. You take the calculated risk. You manage your risk well. And that skill gives you the ability to make a net profit over a series of trades. Right. I saw it early when I started trading, but I missed something. I didn't think it could be so easy. And I thought it was those guys, and they had some perfect method. So later, the gentleman helped me to realize why I could never do it and why they could do it. It's just simply because they respect the structure of the market, right? And yeah, let's let the market show us what it wants to do. If I move my stop loss at this point, anywhere inside this structure, it becomes a bad trade. If I take my trade out now thinking, oh, I'm going to take the little bit of profit that I've got, very disrespectful, it's a bad trade, right? So let's get ready for that partial take profit, modify. Sorry guys, there it is, a bit late. 0.02 and I close. Jack, okay, right. So now I've taken 50% of my take profit. That means that this is almost a break-even trade, right? There's 20% of the original risk is left. So if the market turns around now and just takes me out, then it means if I risk $10, then I just lose $2. So from a mental point of view, there's almost very little risk to this trade. This action of taking your first take profit. And again, just to bring it back to Japanese candlesticks, I don't much care, what this candle said, what this candle said, what this candle said. I saw the structural flow here. Some guys might think, no, the market's going back there, take it out, and then they miss all this potential profit. That's one of the reasons that I don't move my stop loss. Many times the market makes an extended correction wave. If you've moved your stop loss, it takes you out, and then it just simply continues. It was not a structural change. It's only half a structural change. It has to confirm a full structural change before we accept the fact that that's what the market is going to give us. Right there, we have to take 25% of our profit. That is one. Wow, man. Hey, calm down. Right, I missed a little bit, but we took 25% of our profit there. Right, that time is unfortunately over. So at this stage, I call that my second one. I call my salary take profit. There's my risk management take profit. There's my salary take profit. Now I've got a net profit period in my pocket. If the market structure changes, I'll just move my structure, my stop loss up, and I take the rest. But if the market decides to zoom back here and take me out, I've already got a net profit for this trade in my pocket. Respecting the structure over a series of trades is this thing that makes it easy for that net profit. Right, let's see if we can get some more questions here. I love questions, guys. 5 more minutes. Okay. Hi, Tabu. I see some guys that I've been training with. Bezad and William, I recognize. Tabu. Sorry if I don't mention all you guys, but I see we had a good attendance today. Right. Tabu says, please explain again what you mean by saying if you don't get out and the market tells you, you miss a lot of profit. Very good question. When the market structure does change, guys, you get people that get greedy. Now, I don't like to call them greedy. It's greed. It's emotions of greed. We all struggle with it sometimes. The emotions of fear and greed. That's stuff you have to struggle, or you have to just become strong to resist them. And when you have a healthy respect for the structure of the market, then it becomes easy. What Tabu means is now the market went up, it's coming down, it's still an uptrend. We don't try to close out anything, be very disrespectful to the market. But now there is a structural change, right? And now the market starts coming down. Now what I do is I move my stop loss immediately to there. if that was the price, and I get out. That's what the market wanted to give me. Some guys would say, no, the market might change, and then they stay in hoping and praying that the market will go higher. In the first place, it's very disrespectful to the market, right? The structure have changed. In the second place, what happens now is now you're giving back a lot of profit. You've still got an open position. The market spoke, you didn't listen, and now you're giving back profit. We cannot afford that, guys. To be able to make a net profit over a series of trades, if the market is generous, you have to accept it. If the market says, stop, I'm changing my mind, or whatever you want to call it, then we will need to respect it, right? So, yeah, I hope that answers your question, Tabu. Let's see some one or two more other questions here. Like I said, I love questions. Okay, support and resistance. I already said, guys, it can fine tune your trading, but don't ever let it be become or have more weight in your mind than the structure of the market. And I see an excellent example here. Right, let's say you can see there was a sort of like a resistance line there. There was the price bounced, it bounced again. There's a support area there, or sort of a resistance area. Now, what classically happens is the price breaks out, and then there's some guys that say, there's a resistance level, the price is going to motor again, it's going to change, it's going to come down. And then the structure haven't changed, and it's just, hang on. Can you see what's happening here, guys? The market went up, it went down, and it couldn't go higher. Therefore, if it goes past that point, then structurally wise, that's a lower top and the beginning of a next trend. So what guys say is, they say, no, I'm gonna sell here, and they start selling when the market is here. They don't wait for a structural change. They sell, and immediately their stop loss is going to take out. Traditionally, the guys put their stop loss just above the take profit. And they don't feel well, and I don't blame them. Right, so it's much better to wait for a structural change. That's what I mean with the language of the market, respecting the market. Right, sorry guys, I have to leave. We had a nice trade here. The market was generous, not very generous, but at least we got our salary take profit as well. So okay, have a nice day, and keep tuned, keep learning. And let me just go back once. There's my email if you want to contact me. Just be patient, please. I'm very busy, so I will come back to you even if it's a week later. So this week we're moving, so I've got a couple of leave days. Yesterday and the day previous was leave day, so I'm already backed up with my emails. We're moving, so I have to do other things as well. Right, thank you, and goodbye.